In this video, we will give you a profitable and rule-based moving average strategy for scalping, day trading, and swing trading that can easily be used with Forex, crypto, and stocks. We will show you how to identify the trend of any market with the help of the moving average. And the moving average combined with important areas of confluence can create some extremely powerful and profitable trading opportunities, and as always we will show you a profitable rule-based strategy that you can implement into your own trading. So let's begin. A moving average helps smooth out the price movement over a specified period and creates a smooth moving average line on the chart. By using the moving average, the impacts of random short-term market noise on the price are taken away, and you are left with a clean moving average line that can show the actual trend direction. There are two major types of moving averages: simple moving average and exponential moving average. There are some differences between how the two are calculated. However, the primary difference between the exponential moving average and the simple moving average is the sensitivity each one shows to changes in the data used in its calculation. But when should you use simple moving average and exponential moving average? The exponential moving average reacts to price movement quicker because it gives more weight to recent prices. This makes the exponential moving average showing trends quicker and is generally best for short-time trading, which makes it good for scalpers and day traders. The simple moving average reacts to price movements slower. This makes the simple moving average generally best for longer time trading, which means it can show longer time trends in the markets. And don't use the simple moving average on lower time frames because it is slow to respond to movement in price action. This will save you from many losses in the future. Moving averages don't show future prices but past prices. It shows current price direction with a lag. Meaning it's based on past prices. First the price moves, then the moving average moves after. Many trading gurus are teaching to buy and sell whenever the price crosses or reaches the moving average line. You buy here and exit here. You sell here and exit here. But what they don't tell you about taking trades like this is that it doesn't work in the long run, because it will more often than not end up in a losing trade and you will blast your account. Here's what it looks like most of the time: the price is corrective and not trending, with all the choppiness will lead to many false trade signals. The moving average is considered a trend-following indicator and shows you only when the trend has already happened in price. Forecasting a future trend is not possible using only the moving average alone. As you can see in this example, the moving average was still moving upwards, whilst the price was moving down very aggressively. But what I found learning about moving averages, and using them correctly, moving averages can create some extremely powerful and profitable trading opportunities. Moving averages is something that I've used throughout my entire trading career. I still use moving averages to help me determine trend direction to this day, and it's something I definitely would suggest you try to implement into your own trading, as an objective rule in a trading strategy. Also, if you want more videos like this, please smash the like button, subscribe, and turn on the notification bell so you know when new content is released. Moving averages are a totally customizable indicator, which means that a trader can freely choose whatever time frame they want when calculating an average. The most common time periods used in moving averages are 20, 50, and 200 period moving average, because these are the most respected moving averages by traders around the world, so you can very often see a lot of movement in these areas. The shorter the time periods used to create the average, the more sensitive it will be to price changes. Similarly, the longer the time periods, the less sensitive the average will be to price changes. And longer the time period for the moving average, the bigger will the lag be. So, a 200 period moving average will have a much bigger degree of lag than a 20-day moving average because it contains prices for the past 200 candles. But these are the most common and by far the best for helping to determine trends in all markets. For short-term trends, using the 20-period moving average would be a great option for this. For medium-term trends, the 50-period moving average would be a great option. And for long-term trends, the 200-period moving average would be a great option for that. In this example, we use the 20-period moving average. One way to use the moving average to determine the trend is by looking for when the price is below the moving average. This means we only look for short trades when the price is below the moving average. Similarly, when the price is above the moving average, we only look for a buying opportunity. Now, if only one moving average is used, there is a chance of getting caught up in ranging and choppy markets like this. This type of market will lead to unnecessary losses when trend trading. So to try to eliminate getting caught up in ranging markets, we would add another moving average like the 50-period moving average. The downside of using multiple moving averages is that you can miss out sometimes when the actual reversal is happening, but also on the good side, you would stay out of many possible losses this way. So in this example, we use the 20 and the 50-period moving average. When the price is below both moving averages, this means we only look for short trades, when the price is below both the 20 and the 50-period moving average like this. Similarly, when the price is above both moving averages, we only look for a buying opportunity. This can be used as a good objective rule in your trading plan, to build a profitable trading strategy, with the help of the moving average indicator. So now, let's move on to how we can use moving averages in combination with areas of value, and other confluences. This will give you a rule-based trading strategy that you can implement in your own trading, which can give you some highly profitable trading opportunities. As said earlier, the 20, 50, and 200 period are the most respected moving averages by traders around the world, so you can very often see a lot of movement in these areas. When the market is trending, these moving average areas can act as support in a heavy uptrend, as you can see here in this example. Similarly, these areas can act as resistance in a heavy downtrend like this. But we don't just buy or sell when the price crosses or reaches these areas, because the trend will eventually turn or the price can go sideways. You need a lot more confluence and other factors to make this a profitable strategy. These factors will be covered now, so you can get a proven strategy you can implement into your own trading, that you can backtest to see if this strategy suits you. In this example for a buy trade, price needs to be above the 50 moving average and reach the moving average line at least one time. This is the area of value we look for in a buy trade. In this area, we must have a double bottom like this one here. When all these criteria are met, we only need the entry criteria before entering into the trade. This entry criteria would be a solid green candle that indicates a further uptrend like this one. We would place a trade like this with the stop below the swing low and with a very good risk to reward, and this trade went up as forecasted. Similarly, in this example for a sell trade, price needs to be below the 50 moving average and reach the moving average line at least one time. This is the area of value we look for in a sell trade. In this area, we must have a double top like this one here. When all these criteria are met, we only need the entry criteria before entering into the trade. This entry criteria would be a solid red candle that indicates a further downtrend like this one. Again, we would place a trade like this with the stop above the swing high and with a very good risk to reward, and the trade pushed down and hit the target. Here are some other examples of using this strategy. Give us a like if you learned something new and want to see more videos like this. Subscribe to our channel, and hit the bell to stay notified when we upload new videos. Also, Check out these videos here, it's the best strategies out there, so don't miss out. And I'll see you in the next video.